everybody. It's time to get started, and thank you for taking time out of your weekend to be with us today. This is Craig at Max Trading, here along with Chris and Eusebio, and we are really pleased to include you in the Max community today. By the way, this is a very nice trading community. It's a lot of fun. There's a ton of support available, lots of assistance, and free trading workshops every weekend. I hope you have an opportunity to experience some of this. As you know, the markets are always in a state of change, and new ideas and new methods can become really important to help us meet the challenges of trading the current conditions. It was more than 4 years ago now that Eusebio saw the need for a reliable indicator that could help us deal with the changes in the markets. And so he began developing and testing, and the result of that was the MAX Enhanced Trade Format Indicator, which we call the ETF. It has proven itself again and again as a very effective addition to MAX trading, and so now we've added it to every level of our MAX training courses. This means that you can select any level of MAX training, and along with that you will also get the ETF indicator, and you'll learn how to use it along with the companion. The companion is our new bias indicator. It makes a huge difference in results, and all of these things put together, proper training, correct price action analysis, effective indicators, these things will give you a real shot at becoming a successful trader. So it's an exciting time to get in on the MAX system, learn how to use it, take that first big step into productive training. Could be that you just need a source of a little extra cash every week, or maybe you would like to help out a friend or family, a relative, someone you care about, or maybe it's a worthy cause that has captured your attention, and you can just sort of imagine yourself being in a position to really help out and make a difference. Max is the place to be to begin turning your dreams into reality. I think you'll be very glad that you chose to take part in this webinar today. By the way, we do not expect you to just take our word for it. We want you to see for yourself, and I will send you an invitation to attend 2 real-time trading sessions so that you can see on live charts the effectiveness of the system. And you're welcome to attend one or both, or to watch the video playback. Just be sure that you get registered for these. Eusebio is, as I mentioned, the developer of ETF as well as the companion, and that makes him the perfect choice to take us deeper into the world of MAX trading. Eusebio is a phenomenal trader. He won't tell you that himself. He's very much a gentleman and a modest man. He won't tell you things like going 4 years without a single losing day, but he's such a great trader, a skilled teacher, and I believe you will quickly come to appreciate the passion that he has for helping traders become successful. Eusebio, thank you very much for everything that you do for your fellow traders and for taking time to show us MAX trading today. I'll pass the microphone along to you.
Thank you very much, Craig. Hello, everyone. Welcome to this MAX ETF presentation. Let me give you a very, very quick background of who I am for those of you who don't know who I am. So you have perhaps guessed through my accent that English is not my usual language. I am, in fact, a Belgian trader, and I live in France since a lot of years now. Sometimes I share my life between France and Belgium, but I like France. And I am a past software engineer. I have worked almost 30 years, 28 years in the IT industries. And for the last 15 years, in fact, I have had the privilege to work with important banks in Europe. And this has given me the opportunity to be in relationship with some banks traders. But in the meantime, also I have developed a passion for trading and investing. I'm trading and investing much more time than my IT career, and I have tried every tradable market, almost every tradable market, not all. For example, stocks, options, futures, and since 2000, Forex trading. And I am a full-time trader since 2008, after I took the first MAX course with Dr. Jim Pruitt, who created the MAX initially, and then so full-time trading since now more than 10 years. What I'm going to explain you tonight is what the MAX ETF trading system is, and I will illustrate some of the concept with some examples, typical examples, and then I will present small information about the money management we have with the MAX. And then I will pass the mic to Chris, who will continue the presentation of some aspect of the MAX. So the MAX trading system, in abbreviation, the MAX, has been created many years ago by late Dr. Jim Pruitt, known as Tiger, because of a very strong temperament. And his aim was to give traders, so his students, a very powerful but also reliable trading method. But if the MAX is based on very simple concept and some rules, it's not so easy to apply, because there are a lot of things to assimilate and to consider when we have to trade. And so there are two essential keys which are necessary to develop in order to be successful with the MAX: work and commitment. It requires a lot of work to assimilate, to understand, assimilate, and apply correctly all the concepts and the rules of the MAX. And so this requires a strong commitment. Of course, the aim when we trade is to make money. But if money is the only commitment we have, believe me, you will go to a failure. You need a stronger commitment. Money must always be considered as a tool to achieve other objectives in a life. But there are also other keys or skills we must develop to become successful. So discipline, patience, persistence, concentration, confidence. Disciplines and patience, because indeed when we apply rules to trade, we have to wait with discipline and with patience that all the conditions to apply these rules are fulfilled. Then persistence, so, is also an essential skill. You will never get a 100% winning trading system. You will have losing trades. And personally, sometimes when I have, for example, a day with 10 trades, I may have 100% winning rate, but I may have also perhaps 50% winning trades, but sometimes also only 30% winning trades. And the persistence consists in continuing to apply the rules with discipline and patience while we are going through a more difficult or challenging period with more losing trades. And then concentration, because a lot of details must be taken into account. And then confidence. You need to have the confidence in the market. The market will provide you with a lot of opportunities. Then confidence in the methodology you are using to trade, in its ability to catch these opportunities, or many of them at least. And then confidence in yourself, in your ability to apply the rules, the concept correctly. And this is why work and commitment are so essential. So now, how do we define a trading method? I am always amazed when I see the description of other trading systems that very often the method is not exactly described in terms of objectives. And the MAX is in fact a trading method to catch trends. And so it is, at my sense, a necessity to define what the trends we want to catch are. And so we have to define, in fact, the movements to trade. We have also to define when they can possibly start and how they can possibly start. And we will use for that a term we know, we name them setups. And a setup, an entry setup, will consist in a certain number of criteria to be fulfilled. And then, once we recognize a setup among all the setups we have at our disposal with the MAX, we have to define when that setup is valid. And we validate our entry setup always under three types of conditions. The technical conditions, because we we define these setups based on price patterns, basically. And then we have also to validate the setup in terms of risk. Is the risk associated with that setup an important risk or not? And then we have also to consider that the setup is in agreement with the global context. By global context, I mean every element like news releases, central banks' operations or decisions, geopolitical events, and so on, which may affect the markets, specifically here the Forex market. And so when all these type of conditions are fulfilled, then we have a trade with a possible trend starting. And then we have to define how to handle the trade. What do we do along the trade in order to progressively reduce the risk on the trade and possibly cancel the risk on the trade when we reach a position of a risk-free trade. And then when we are in a risk-free trade situation, we can think to optimize the profit. And then, of course, we have to define how a trend may possibly exhaust. I don't say how the trend will reverse because we are never sure 100% certain when the trend will reverse, but we can pinpoint when a trend is at least exhausting. And when the trend is exhausting, it's a good opportunity to exit the trade. And so this is how we define, in fact, the MAX. And the MAX, to go a little more into the details of the MAX is an acronym which stands for Momentum, Acceleration, and Exit. The M stands for Momentum, and I should say more specifically Momentum and Volatility. We need to have enough momentum, not too much, and enough volatility, not too much, to have, in fact, a good trend starting or trade starting. And then the A stands for acceleration. By acceleration, I do not mean the price is accelerating. What I mean by acceleration is when we are in a trade and the trend is unfolding nicely, we will have, under specific conditions, a possibility or several possibilities to add to our initial trade in order to progressively build a larger position without increasing the risk we have on that position. And this is extremely important. And so acceleration means accelerating the profits we can extract from the same trend by adding, by scaling in, sometimes by scaling out also, along the trade. And then the X stands for exit. We have two types of exit with the MAX. We have the scaling out, which is the opposite of the scaling in order to bank some profit to reduce the risk on the trade, on the position, and then we have a final exit. I will illustrate that process in an example just in a moment. And so the MAX, as I have just said a few moments ago, is essentially a trend following method. In the past, with the MAX, the classic MAX, before we introduced the ETF concept, we were making the distinction between a trend, a counter trend, and a consolidation area. Now, with the MAX ETF, we no longer need the concept of counter trend. We have only trends or directional movement and possibly consolidations. And so we can trade these two types of movement. And of course, having the possibility to define good entry setup is not enough to handle a trade correctly. We need to have also a very strict risk and money management technique. And we have rules for that in order to either control strictly the risk we have on the trade as long as the trade is opened, and then money management rules in order to control how the account is growing trade after trade after trade. And the MAX, in fact, is applicable to any time frame and to any market. I will illustrate that also with some examples. I will show you some very recent examples I'm going to illustrate. And understanding what the MAX is important, of course, but understanding what the MAX is not is also very important. The MAX is not a scalping method. We are not interested to try catching just a few pips in the shortest period of time. We want to catch an entire trend during period or during inside the time frame we are trading. And if we exploit the news releases, we don't trade the news by itself. We don't try to catch these important spikes the price is making when we have a news release with a big surprise. But we can, of course, trade the movement after the news release, once the volatility has settled down. And the MAX is not an elementary buy and sell system with fixed and rigid rules. We have several types of entry setup which takes into account different types of market conditions. So the entries, as I have said, are defined as opportunities based on, so I repeat it, technical aspect, risk conditions, and global context. The other side of a trade are the exit setups. We also define conditions when to exit partially or totally a trade. We call that an exit setup. And the setup is always based, in fact, or the decision or taken on these setups are always defined as risk situations. So as soon as we perceive that a risk is appearing for the trade, we have to take a decision to reduce that risk. And for the exit setups, we use several types of tools. We use technical indicators, we use pure price action behaviors, we have a combination of both. Also, we use timing aspect, especially when we day trade. There are certain periods during the day or several times during the day when we have more risk for the trade, and we have to take that into consideration. And then we have also the concept of movement invalidation. And of course, naturally, this is not mentioned here. We have also the concept of movement exhaustion or possibly the movement reversal. When we consider a trend following system, we may face some challenges. And this is a series of challenges we have faced these last years during the 3, 4, 5 years due to a decrease, and you have perhaps observed that yourself, an important decrease year after year of the average daily range. So a decrease in the momentum, not necessarily in the volatility, but in the momentum. And so when this happens, and I will illustrate with an example in a moment, we will get more often poor price action or small price movement. And when we have small price movement, a trend following system has some difficulties to catch good profit. Because we use indicators, and we all know that the indicators lag, that's true. In some circumstances, the fact that an indicator is lagging is not fundamentally a problem. The problem comes when the price reverses very quickly. In such a case, we may miss some good, ample movement. And so, in the classic MAX, we had previously, as I have said, the distinction between trends and counter-trend. And I have always been personally frustrated with that distinction, because for me, a movement is a movement to trade, and there are all these reasons why the price is moving in one direction. And then most of the trading system still nowadays are using time bar charts. They are good to see some aspect of the price movement, but they have also some disadvantages. And so one of these disadvantages is we lose some details in the price movement itself. And when we have introduced the MAX ETF, the aim was to, in fact, solve all these problems at best, not necessarily in all the cases, but at best. And so, just to illustrate the loss of momentum these last years, I'm showing here two charts on the euro-US dollar and on the pound-US dollar, for example, over a period of 8 years, almost 9 years. And these two charts show the evolution of the average daily range. And we can see that at some period the average daily range is very high, for example, more than 200 pips. And sometimes they are very low as 50 pips per day on average for a pair like the euro-US dollar. And so over years, especially since 2008 with the subprime crisis, we have seen regular drops in that volatility. In fact, I should say the chart is not correctly labeled, but this comes from the site I have used to take these charts. So it's not the volatility which has decreased, it's the momentum. this chart shows the combination of momentum and volatility. And we observe exactly the same thing with the pound. And I have taken here two examples of major pairs, but we have exactly the same behavior with other currencies, for example, the euro kiwi or the pound yen, for example. This is true for any pairs. And for the moment, with some pairs, especially the pound pairs, we are seeing a small increase in the volatility due to the Brexit situations for the last few months or 1 or 2 years. And so this has been an important reason for us to introduce the ETF concept, which, as I have said, solve these kind of problems. As Craig has mentioned a few minutes ago, the ETF were available as a separate course, but since last year or 2 years ago, we have decided, because it is an important improvement to the MAX, we have included the ETF concept in all our MAX courses. And what I'm going to illustrate today now is the comparison between the MAX ETF Primer and the MAX ETF Standard. The MAX ETF Standard is our flagship course, and the MAX ETF Primer is just for the students who enroll in this class, a first contact, a first approach with the MAX. It is a very, very simplified version of the MAX, as I will illustrate, just to give you an idea what the MAX may be and if it may be suitable for you. And so now let me illustrate, in fact, by some example, what you can expect with the MAX ETF. Let's take, for example, here the pound-yen pair. It was a movement this week. It was on the 23rd of January. It was 3 days ago. And so the price was moving in an uptrend, obviously in an uptrend. So with the MAX Primer, we have very simple trades. One trade is made of 2 or 3 decisions. First of all, we open the trade, then possibly we close half of the trade, and then the last decision is to close the remaining open trade. Let me illustrate that on this chart and explain what we have on the chart. So the orange and the yellow line you see here on this chart is what we call our ETF lines. Our ETF line is a special kind of moving average. It is a very sophisticated moving average we are using in order to have the following feature. First of all, it is less sensitive to the pullbacks than many other moving averages, and then it is very close to the price action itself, and when the price is nicely moving in one direction, the ETF lines are extremely regular, almost linear. And you can see that by the fact that the two lines are well separated and almost parallel all along the up or down movement. But this is not enough to define a trend. The trend is defined, in fact, by the companion indicator, which is the indicator here at the bottom of the screen. We have 2 lines. We have one line in red and green. This is our companion indicator. It indicates the direction of the trend to consider. When the line is green, we consider only long trades. When the line is red, we consider only short trade. And sometimes the line can become red, like in this portion here, but in this portion of the price, we have never a short trade, in fact. And we have another line in blue and brown, which is called the fast bias. The previous one, which is called the companion indicator or the slow bias. So they are basically the same indicator but with a different time horizon. The fast bias help us to validate some of the entry setups we may have on our chart. And so what is an entry setup? In fact, here, where I have that small angled white line, this represents an entry for a long trade. The entry is called an ETF REMO. Mo means momentum entry. And this corresponds to a specific pattern the price is making. Every setup we have defines a very specific pattern made by the price. And to have a long setup, we need to have the slow bias green And sometimes, depending on the setup, we need to have the slow bias going also upward. And then we have other conditions allowing to validate the technical aspect of the entry setups. And then we define a stop loss. Of course, we have rules to define where to place the stop loss and what size the stop loss must have. And then we have to consider the risk associated with the trade, and then we need to have the global context in agreement with the trade. If the global context tells us that the bias, the fundamental or macroeconomic bias is to go long with the pound, then this entry makes sense. A short trade would not make sense in this case. And so everything were in agreement, the technical aspect, the risk aspect, the global context aspect, so we can take that trade. At some point here, you can see that the price is making a pullback. This kind of pullback, we cannot say what kind of pullback we'll have. It represents the fact that the price is making a retracement, but a reversal always starts with a pullback. And so a pullback represents a risk on our trade. And so we have several types of exit techniques telling us that the risk becomes too much important. And when the risk becomes too much important, we have to take a decision to reduce that risk. One type of the exit technique we are using uses some technical indicators. You have an example here. It is the RSI, the stochastic of the RSI, and the pattern of this indicator will give us exit techniques. We describe that in extreme details in our courses. And so when the risk becomes too much important, we have a way to quantify when the risk is important enough. We have to take the decision to close half of the trade. Indeed, whenever we open a trade, we consider the trade is made of 2 units. The size of the trade is calculated with our position sizing concept, but we consider it is made of 2 units. And when we have to close partially the trade to reduce the risk on the trade, we close 1 unit, so half of the trade. And we call that an MX, a momentum exit or a minor exit. And then when we have another exit technique appearing or occurring, we close the second unit and we call the final exit of the trade an XXX, a triple X. And so you can see in this example, the first unit has got a profit of 36 pips, the second one of 33 pips, and so the result of this trade is 69 pips, and because the stop loss was 31 pips, the reward to risk ratio is 1.11 R. R represents the risk. If you take a risk of 2% of your trading account, for example, this trade has produced a profit of 2.22%. So, and then if the trend continues to unfold, so we have another entry setup. This is another type of entry setup. It is called a bio-remo. The conditions for that setup are different from the first setup. We have several types of entry setups, and we apply the same methodology. When we perceive a risk in the trade, we close 1 unit, and in this example, we have a losing unit. This unit loses 7 pips, and then the trend resumes to the upside, and then we have another exit technique triggering here, forcing us to close the second unit of this second long trade, catching this time a profit in such a way that this trade produces a smaller reward to risk ratio, but a positive one, 0.46 R. And so 2 trades, and after that there were no other opportunities to take. And so 2 trades with a nice 1.57 R profit with a risk of 2%. This represents more than 3% profit. So this is what the MAX Primer is doing, simple trades. With the MAX ETF standard, we have a very powerful mechanism we call the scaling technique, which will consider the trend, the movement in another way, but in such a way we can progressively add to the trade to build a larger position. Let me illustrate that. So the same movement now with our scaling techniques. We have the same, another previous entry setup, which is not available with the MAX Primer. With the MAX Primer, we have basically 2 entry setups. With the ETF standard, we have many more possibilities for our entry setups. In this case, the setup is called a BioMo. And then we have at this point, because all the conditions are fulfilled the possibility to add to our trade. We call that a scale-in, so the scale-in number 1. Then we have an exit conditions triggering, forcing us to close 1 unit. At that point, we are left with 3 open units. We had indeed 2 units with our BO more, 2 units with the scale-in, number 1, and then we close 1 unit. We are left with 3 open units. Later on, when the price resumes its up movement, because we are still in an uptrend, so we have the possibility to make a second scale-in. We are left now with 5 open units. And then we make another MX, we close 1 unit, leaving us with 4 open units, and so on and so on. We make a scale-in number 3, an MX number 3, a scale-in number 4, an MX number 4, a scale-in number 5, an MX number 5, an MX number 6, and then here we have our XXX. This XXX, so is the final close. We close all the remaining open units. We were left with 6 open units. And so this is the scaling technique. So this is one unique trade with several scale-ins and scale-out, or MX, producing a profit way, way larger than the 2 trades made with the MAX ETF primer. The total number of pips here was 476 pips, with a rather small stop loss, 18 pips, producing a nice 13.22R reward to risk ratio. With a risk of 2%, this represents a profit of 26% on the trading account, 26% profit on the trading account, to be compared with the 1.57R of the MAX primer. And so this shows the power of scaling in and scaling out along the trade. Of course, when we have that XXX, in this case, we have observed that the trend was possibly reversing. This corresponds to an entry setup to go short. But there was something else. Remember, I have said that we have also the global context to take into account. Among the global context, we have, for example, timing consideration and price, sometimes some kind of price behavior. You see here a small red rectangle. This represents a time period in some circumstances when we have a 75% probability to see that kind of trend exhausting, not necessarily reversing, but exhausting inside that time period. And you can see that the highest high of the day was right inside that red box. And so when we get that exit technique, it was a perfect place to make our XXX. We had the combination of a possible ETF trend reversal with that timing aspect during the day. But the global context was not favorable to take the short trade. And so we have not taken the corresponding short trade, even if the movement would have been possible to trade. So considering taking trade in the direction of the global context helps to make less trade, but with more relevant trades, in fact, more pertinent trade. On the chart, you see also this kind of horizontal line. This is a white line. This line represents what we call max price levels. I produce them every weekend. And these max price levels, there may be several on each pair, represent supply and demand level of the pair. They are specific to each pair. That day, there was only that level here on this pound-yen pair, and you can see that all our entries were on the right side of the max price level. We have not made an entry below that max price level, so we were on the right side of the demand, of this demand level. By the way, these max price levels are available for free for 4 pairs, the Euro-Yen, the Euro-US dollar, the Euro-Aussie, the Aussie-Yen, and the Pound-Yen. So they are freely available. It's a free subscription. But for those who want to get the levels for many more pairs or indices or commodities, so there was a small monthly subscription, so to have approximately 30 instruments to consider. So Craig will place the link of our website if you want to subscribe to the free subscription, for example. And tomorrow I will send the levels for the coming week. These levels are valid for the coming week, in fact. So this was an example of a trade on a pair on the 5-minute time frame. I have said that the MAX can be applied to any time frame and to any market. Let me show you here an example of crude oil. We have several of our MAX graduates who trade some commodity, for example, gold or crude oil, or some other commodities. And this is the example of oil with the 30-minute time frame. We are not limited to the 5-minute time frame. We can trade any time frame, and the structure of the trade will be exactly the same. So here at some point, we had, after a nice drop in the price, we have observed here an ETF trend reversal, and at some point we get an entry setup here with a rather small stop loss, 0.8 points on this contract, and then we follow exactly the same methodology. At some point when the risk becomes too much important, we make an MX closing 1 unit of our trade, and then the price resumes its up movement in this case, and at this point we had another exit technique triggering, allowing us to close the remaining open unit before the trend has reversed. And this second unit has got a nice 3.7 point. And so the trade was a nice one with a reward to risk ratio of 2.41 R. So if you consider a risk of 2%, this represents approximately a 5% profit, a little less than 5% profit. So on the 30-minute time frame, this is an example of a commodity. Now the same movement with the MAX ETF standard, when we use the scaling technique, gives another different profits. We have the same initial entry, the same MX, then we have a possibility here to scale in, then we scale out here, we have another scale in here, then we have the same exit as previously here as a scale out, and then we have the final exit, because here we had the possibility for this trend to exhaust through our ETF trend reversal. So, and you can see that through that scaling with two scale-ins, only 2 scale-ins, the reward to risk ratio was more than the double of the reward to risk ratio of the MAX ETF. A nice 5.81 R profit, considered with a risk of 2%. Even with a risk of 1%, it's still a nice profit to consider for such a trade. So this is an example of a commodity. But we can trade also indices. And this is an example of the Dow Jones. You have contract, you can trade on the Dow Jones, for example, the E-mini. You can trade similarly the NASDAQ, the S&P 500, and so on, the DAX, for example, the FTSE 100. So here is the Dow Jones on the daily time frame this time. And so you can see the structure of the trade is exactly the same as in all the other time frames and the other instruments. So we have an initial entry in agreement with the trend, the ETF trend here, and at some point we make a scale out or an MX and then an XXX. And when we initiate, as long as the trend stays valid, another long trade with exactly the same structure. And so you can see the kind of result these two trades have given during that period of time, which was a rather recent period. So it was last year. So a nice 6.13 hours with the MAX primer. With the MAX standard, so we have the possibility to consider the movement as a unique movement, but with the scaling technique, we had the possibility here to make 1, 2, 3 scalings, only 3 scalings. We have in our arsenal of techniques the possibility to tell if when we have a scaling possibility, if this scaling is risky or not, and if the scaling is risky. For example, there were 2 possible scaling here, but they were very risky, so we decide not to take them. So 3 scalings were enough in this case with a few MX, 4 MX, and then the final XXX, so to capture a nice 15,800 points on the Dow Jones, and with a stop loss of 400 points, so the reward to risk ratio was an amazing 19.76 R in just a few weeks of time. So starting at the beginning of October up to the end of January, so October, November, December, January, 4 months. So a 19.7 R reward to risk ratio in 4 months on the daily time. So an amazing trade with in agreement with the trend. So So with the MAX ETF, either the primer or the standard level, so we can trade, as you have seen, so any instrument, Forex, indices, commodities, stocks also, and in any time frame. So, of course, we don't have a 100% winning rate. We have losing trade. With the MAX, we have a winning rate of approximately 70%. Sometimes a little less, sometimes a little more. It depends on the market conditions. It depends also on the time frame. Generally speaking, with a higher time frame, we have a higher winning rate. But it depends mainly on the market condition. But when we have a losing trade, the losing trade has always a very small loss. This is an example of a typical losing trade. So we had, for example, here we were in a downtrend. We had a short entry setup, and then a criteria to close one unit, and then the price has reversed against the trend, and so we have been forced, following our rules, to close the second unit with a loss in this case. And globally, the trade was a losing trade, but with a very small loss, a very tiny loss, minus 0.11 R. With a risk of 2%, it's a loss of only minus 0.2%. So a very tiny loss, which is easily recovered with one small winning trade. Now, of course, sometimes the loss will be smaller, but sometimes it will be larger. But on average, when we have a losing trade, the loss is around minus 0.4 R. So less than 1/2 R loss for each losing trade. When we have a winning trade, so especially with the MAX ETF standard, we have typically a reward to risk ratio of 2 or 3, and very often more than 2 or 3 R's. And another great advantage of the MAX is we have criteria to recognize when the price is in a choppy mode. When we are in a choppy market, we simply don't trade. Or if we have a valid entry setup and we decide to trade it, we have to trade it in a very specific way we teach in our course. This is an example of a choppy market when the price is moving in a very erratic way. We have several criteria to recognize such choppiness, and so when we recognize such choppiness in the market, very often it's wise not to trade. But we have still the possibility to trade this kind of movement, but being extremely careful in the way we handle the trade. So in such a way that with the MAX we can trade under any market conditions, in fact, and this is what the trading system should be. It should allow the trader to trade under any market condition, a trending market, a consolidating market, or a choppy market. We have also a strict money management rule, and what we do is, first of all, when we have profit, we compound the profit. When we have drawdown, we can handle the drawdown in a specific way to reduce the effect of the drawdown. And it is extremely, we have an extremely powerful procedure I explained, for example, in our MAX Advanced course, a procedure which allows to even completely control the drawdown we may face. For example, we can predefine in our methodology the maximum drawdown we can accept, let's say, for example, 15%, and then if we are facing a losing streak made of many losing trades in a row, we can modify something in the way we trade, especially in terms of risk, in order to be guaranteed to never exceed the maximum predefined drawdown. So we have a complete control of the drawdown, and this is feasible. We can do that because it is a mathematical problem, in fact. So, but when we are in favorable market conditions, we can compound our profit, and with the kind of compounding process we have, we can have an idea of how an account can grow. And so let me show you a very quick example here. Let's suppose we start with an account of $10,000 and we use a risk of 2% per trade. Of course, when we want to make some projection into the future, we have to make some assumptions. And so let's consider we have an average stop loss of 30 pips. Very often with the MAX ETF, we have a smaller stop loss. But let's be Or let's stay conservative and let's consider a stop loss of 30 pips. And let's consider a profit of only 1 hour. Remember, we have 2 units per trade, and so the 60 pips here represent the profit of the 2 units. This is not the real result of the trade. The average result of the trade is half that number, so 30 pips. And so when we divide the 30 pips by our stop loss size, we have a 1-to-1 reward to risk ratio. And let's suppose the objective is to double the account. Under these conditions, and provided we trade, for example, every day, which is not necessarily easy, don't get me wrong, because we have all our constraints, but let's suppose we are able to trade every day, and every day we are able to produce on average 1 hour profit, which is still not necessarily easy, but it is just to get an idea of what we can achieve in terms of account growth. And we suppose we make no withdrawal from our account. And so if we trade every day, we are able to double our account in 36 days, almost 2 months. But this requires a very strict condition, applying correctly the concept and the rules of the MAX in a consistent way. It's the consistency which allows to achieve such kind of performance. Now, because we are not necessarily able to trade every day, because every day we will not be necessarily able to catch such average profit so every day, someday we can make more profit, someday we can make less profit, someday we may have a loss. So we will require more days to double the account. But you will have at least a good idea of what can be achieved in terms of account growth, in fact. And when you know that this kind of result can be achieved by consistency in applying the rules and the concept, so it is in the interest of the trader to apply correctly these concepts and rules, and so this will require for the trader to practice a lot in order to be sure that the rules and the concept are applied correctly. Practice is an important aspect in our approach. So I'll show you another example, but there is no interest. And so our MAX courses are in fact organized in 5 levels. We have the first level, which is the MAX ETF primer course, which gives you a very quick idea of what the MAX is. Then we have the MAX ETF light course, which is only available to the MAX standard graduates. And then we have our flagship course, which is the MAX ETF standard with the scaling and scale out technique. And then we have also the MAX advanced course, for which we go way more in depth in some concept, and we have also in that course a more global view of what trading may be, considering other aspects of trading. And then we have a very specific level of the MAX, which is called the MAX ETF SAM, which consider many more details in the price action itself in order to have many more opportunities to handle the trade and to catch more profit from the trade. But the 2 courses I have presented to you today were the MAX Primer and the MAX Standard course. And so in conclusion here of my presentation, so with the MAX we have a very strong methodology based on sound concept. During the course we explain why this concept works in relationship very often with what big boys are doing in banks, for example. And during our training, we reinforce a very important aspect. We use indicators, of course, we use price action, but we don't trade the indicators, we trade the price action itself. The indicators are simply there as tools, helping us to pinpoint faster some specific situations when we have a potential opportunity to open a trade and when we have a potential situation of risk, when we have to consider reducing the risk on the trade we are handling. And we have associated with our rules and concept a very strict, solid risk and money management technique. And in fact, the trade risk management is always the most important aspect in the way we trade with the MAX. Once we are in a trade, we consider that the risk is the first priority to handle for the trader. Never the profit, never the loss, so never the ending result, only the risk. risk aspect. If we handle correctly the risk, the profit will follow by themselves. And for that, during our training and practice session, Chris will explain a little more about the practice session. So we insist on the personal confidence development through our mentorship approach, the homework we associate to each training sessions, the practice we ask our students to follow, and the follow-up support we have in our Max community with the workshop, with our forum, with our scrolling parties, which are practice sessions. So this is what the Max is. So if you have any questions about what I have presented, feel free to post your questions in the questions area. And now, so I give the mic to my friend Chris for the rest of this presentation. Chris, it's up to you.
Hi everybody. I'm partners with Craig and Eusebio in this in the MAX trading system. I'm based in New Zealand, if anybody is wondering what my accent is. And this is the 62nd set of our MAX courses that we're running. We've been running them since about 2007, 2008, and there's been over 2,000 people who have gone through the courses. So just to let you know that we're solid, we've been around, and kind of know what we're doing. Should do by now. So one of the most important parts of the MAX, and that makes it sort of stand out from pretty much every other training setup that I've seen, is that we ask you to do homework. And the reason for this is that we can verify that you actually understand what we've presented to you. And it also makes you an active participant in the information that's coming through, and it helps crystallize the information. As well, when you send the homework in, everybody else gets to see what you've done, you get to see what everybody else has done. How we want the homework to come back is just a simple chart, he says in quotation marks, marked up with whatever has been taught in the last session, and you send that in. There's no sort of essays or anything like that to do unless you want to ask questions. So you send the chart in, and we reply to it. We go through it pretty much bar by bar and give an explanation as to what you've done wrong, where things should be better set up and stuff like that. And if there's anything that's needed to be sort of corrected or redone, then we'll ask you to go over it again. Here's a table of the courses. What we've got on offer today are the first two that are lined up there, ETF Primer and the ETF Standard. The Primer runs for 2 weeks and the Standard runs for 7 weeks. And there's actually an extra bonus session with each one of those as well. The Primer is just there to give you a taste of what we're like. If somebody's sort of, well, you know, I don't know about this. So if you want to try it out, then go for the Primer. But if you really want to make profits, do the training, help yourself out of retirement or into retirement or whatever, then the Standard is the one to go for, because that will pull in the profits much faster. So to wrap up, our MAX courses are very detailed and precise, as you would have seen from what Eusebio was talking about. We find the setups, whether it's an entry setup or an exit setup, and then the execution is within, it's got 1 to 4 pips there. It depends on how the market's moving. Sometimes it's within half a pip of the open, or sometimes it could be 6 pips if market's moving really quickly. Just depends, but that's on a 5-minute chart. We use the MetaTrader platform for the training because it's free, it's available, there's no data feed that you need to worry about. And we use the same platform for everybody in the training. It's just so that everybody's charts look the same. We supply all the templates and the indicators, so there's nothing for you really to set up. But we also have the indicators for platforms like NinjaTrader, TradeStation. If we don't have the indicators for your particular platform or your particular version, then I can supply the source code for our indicators so that you can get them ported over to your particular platform. There's no problems with that. After the course, I've said we'd do the practice sessions, which we call the scrolling parties. There's a news watch list, the forum, and Eusebio has also added the levels now, and there might be some development on that shortly or soon, hopefully, coming up. What we want out of all this is that you get really good training from us, and you have a solid trading method we'll supply you with as much support as you ask for. What we want you to end up with is the ability to to achieve your goals, to become debt-free, help you in your retirement, keep you independent, and it's especially has been highlighted a lot with the US and the UK lately, with people not knowing if they're going to have jobs or when their next paycheck is coming. So by learning something like this now, you'll be able to set yourself up. So here are what the courses cost. The Max Standard, with all the profit acceleration money management, runs for 7 weeks. And then after that, you've got unlimited scrolling bar. It starts on February the 8th, which is not this week, but the week after. And it runs, Eusebio will be running them, starts at 3 o'clock, and runs each one of those weeks for those 7 weeks. The normal price for this is just under $3,000, but for the webinar, we've got a $2,399 special with payment plans available. You need to contact Craig about that. If you want to do the 3 courses, which is the primer, the light, and then the standard. So the primer runs for 2 weeks, the light runs for 3, and the standard runs for 7 weeks. So you're pretty much up for over 4 months worth of training there. It's 2,679. So you'd start off, there's a lot of repetitions, so you get a really good grounding in the basics of the max with that. It takes longer, but if you're only just starting out, that could be the way to go. The link to sign up for it is down the bottom there, maxtradingsystem.com/max-standard-special. And on the next page, Eusebio, if you just want to try out the primer to start with, like I said, it's only got a couple of entries in it. It's slower, less profitable. Still profitable, but not as profitable as the standard. It's just there to give you a taste. Runs for 2 weeks. It starts on February the 12th after the standard, and again at 3 p.m. The normal price is $329, and we've got a webinar special of $159. So if you're really serious about this, the primer is good to test us, but the standard is the one where you will actually learn more about trading, more about trading, and how to maximize your profits from it. Some of the other questions that we've got are, and we get these things popping up all the time, like how to stay consistent and to keep with a maximum win-loss ratio, how to keep the drawdown low year after year, even during unexpected financial events like Black Monday that occurred a couple of years ago. So I'm going to bounce this little ball off over to Eusebio. So if you can answer that one, Eusebio.
Yes, Chris. Indeed,
Cool.
one way to get to be consistent. It's not necessarily to get consistent in the profit, but to get consistent in the process. And so this means that once you begin your trading session, and until you stop your trading session, whenever you have to take a decision based on the concept and all the rules, you have to apply that decision. Never try to overguess what the end issue of a trade will be, but consider all the concept, all the rules under the 3 types of conditions I have mentioned: the technical aspect, the risk aspect, and the global context aspect, to time your trade, to pick your trade, and then handle the trade following the rules. That way, you will go through losing trades, of course. For example, myself, my maximum losing trade is 6 losing trades in a row. But I don't worry for that, because I know that on the long-term perspective, over 100 trades, for example, I will get my winning rate, my average winning rate. So if you consider that the quality of a trader is based on a small number of trades, this is not good. You have to consider more trade. But to be consistent, just follow the rules and take the decision when the decision must be taken. So following the rules.
Okay, thanks, Eusebio. And a couple of questions have come up. even for the discount that Craig mentioned, can we have the payment plan with it? And yes, Craig has answered there's no problems with that. So you can get the extra discount on top of the webinar discount and the payment plan as well. So no problems with that. We're going to have the recording of this webinar. And yes, after pretty much every session, all three of us are making recordings of it on our globally, Belgium, the States, and down here in New Zealand, and on multiple desktops. So it's very rare that things are that bad that we don't have a recording of a session. So we do send them out pretty much every time. And Simon's asked for the email again, Craig. It's in the chat area, Simon, if you can see that. Okay, and what else? Another question which we get as well. I'm still in the phase of exploring trading and yet to get my feet wet. There's another one for you, Eusebio. There's so much clutter with mutually contradictory information that it practically becomes impossible to get the right information with confidence. So naturally, my biggest question is how to get started and then survive learning to trade.
This is a good question and a difficult question indeed, because when it comes to trading, we have to take into account a lot of information. I have said, for example, that the price of many instruments can be influenced by several types of events, the news releases, the central bank decision, some events about the commodities, for example, so an intermarket relationship may arise too, some geopoliticals. And so if you consider taking a course which does not mention these elements, you can be sure that you will get wrong with that course. Any serious trading system and trading courses must include these type of information, and when you can get these information. So with the MAX, we don't necessarily consider all these information because it's an endless process to search for the right information, but we get a lot of information we can take into account, for example, with the news release and the geopolitical. So once you understand that aspect, you will better understand why you trade. And it's important to understand why you take a trade. If you don't know why you take a trade, you are gambling, in fact. Okay,
thank you. And some more that I'm just going to keep hitting you with the questions, Eusebio. A whole pile of questions come through regarding around a similar topic, like, for instance, what's the precise strategy to trade? How do I identify the appropriate entry and exit points? How do I know when to pull the trigger? How do I improve my odds of staying in a trade that's starting to run? I seem to get whipped around like a rag doll some mornings. And other questions like that, Eusebio.
Yeah.
This is what the course is about, essentially.
Yeah. Indeed. This is why we have tried to simplify the process by defining entry setups and exit setups to know when to consider the trade and what are the conditions for the trade to be valid. And we go deeply in these aspects in the course.
Okay. Having asked that question, some of the MAX students have been saying, can we have examples without too many choppy trades? Tomorrow, please. Those are the hardest ones to trade. They're the best ones to learn on as well because there's so many details in it. But we'll see what comes up, Robert. If you can send through a chart, we'll go through it for you. Okay, what else? I think the single biggest question which I have comes to mind is how to determine when a trade has totally run its course and is about to reverse on you. How to spot when a trend is changing. Go, Eusebio. I think you've invented something to help with that.
Yeah, in fact, we have developed for that our companion indicator. So the companion indicator, which we call also the slow bias, gives us the direction of the trend to trade until this bias reverses. Now, the global context, the understanding of the global context will tell us if we can take the trade or not. And so the end of the trend, the exhaustion of the trend is given by our companion indicator. Now, when we have a trend exhausting, this does not necessarily mean that the trend is reversing. But sometimes, of course, the trend reverses. But again, as I have said, the global context tells us if we can consider or what trade we have to consider to take. So it's the combination of both which allows us to pick the trade.
Okay, I don't want this to go on too long, but I've got another nice question here. I've just lost it. Can you address trading while employed full-time in a non-trading occupation? I know market opening provides best time for volatility, but when is the next best time on average if you don't counter-trade the opening of the US market due to other commitments?
In fact, the best time to trade at least the Forex is the European session. Because the European session, during the European session, we have around the London Open, we have the overlap with the Asian session and the London session. And during the afternoon in Europe, we have the overlap of the London session with the US session. Generally, the first part of the Asian session and the last part of the US session are not really appropriate to have good trends. The market is the market, and we have to comply to the market. And so we have, as traders, especially when we trade full-time, we have to adapt our trading session to the time period when the movements are happening. This is true for day trading. And so you have to adjust your trading session. Now, if you don't have the possibility to day trade, you still have the possibility to use a higher time frame. For example, if you have another occupation, so another profession, you can trade part-time, but then you have to choose the time frame which best suits your time constraint. It may be, for example, the 4-hour time frame, it may be the daily time frame, or it may be any in-between time frame. We have traders, for example, trading the 8-hour or the 12-hour time frame. And so you have to choose the time frame which best suits your own time constraint. With higher time frame, you have no longer the constraint of the best moment to trade during the day as we have in day trading. So,
okay, thank you. Simon has popped up from a long time ago and said, I took Prime and Light a few years ago, but did not use it. And it's not ETF. What should I do now? So Simon, I think Craig is going to send you an email to let you know how you can upgrade to the latest versions of the standard, of the MAX, because the MAX keeps evolving as the markets change. It's a really comprehensive method. So people that learned the MAX back in 2007, 2008 with Jim and back when we first started, the methods are still working, but Eusebio has kind of turbocharged them. Back then, the markets were moving like huge runs every day. The pound yen was kind of like 600 pips. Trend movements were pretty sort of regular. These days, we're lucky to get 60 to say 120, 200 pips on average out of them. So much smaller. So Eusebio has cranked things up so that with the ETF, so that we can track movements in a trend direction as well as a counter trend direction, not just one direction. So we get a lot more access to the market, and that's what the ETF is all about. So when the new version or the modifications to the MAX were brought out, then we made allowances for old MAXes to be able to catch up as well, with a very nice pricing on the new training. So you can almost, yep, okay. So Craig will send that information out to you. And if you have any questions, old MAXes about that, let us know. But there was a really nice segue that I just thought of into a question that I'm desperately looking for at the moment. And then we'll call it quits. Trading full-time. Okay, no, sorry, that's gone out of my head. Happens a lot. But did have a question about the brokers. I don't know who is a trusted and sincere broker to use. So, Eusebio, do you want to have a go at answering that question? Like,
yes,
what broker should we use?
We don't advise any broker because it's a delicate problem, and depending on your country, so you may have different choices, and some brokers in one country, in some country, will not accept customers from other countries because this depends on the agreements each countries have. It's your own responsibility to choose your broker, in fact. But it's true that in the past there were several brokers who were not fair or not fair enough, screwing up their customers. But fortunately, these last year there has been a cleanup in the market of the brokers, and most of those who are still exercising for practicing for many years so are pretty much good brokers. So, but it's a good practice, an advice I would like to give once you decide to open an account with a broker is to get regularly in contact with your broker, because it is important for your broker to know who you are and what your problems may be. More contact you will have with your broker, you will be amazed on how more fair or fairest your broker will be with you, understanding your problem, understanding your objectives. So the relationship with the broker is important. Now, of course, you can always look through Google for brokers. There are several websites giving a list of brokers. There was a famous 100 list broker you can find very easily, and you have a good choice within them. Don't believe necessarily that the broker always trades against you. This may sometimes happen, but it's less frequent nowadays than in the past. But you have to understand the business model of the broker. All the brokers don't have the same business models. Some are interested to simply catch the spread through the trades. Some other, due to the obligation they have with their liquidity providers, have to aggregate several trades of several traders before routing the global package of the trades to the liquidity provider, and so you may have some slippages in your executions. It is not the fault of the broker. It's the way the broker has to handle the trades in relationship with their liquidity providers. This is why having that kind of relationship with your broker is an important aspect of trading. Try to understand his business model, and you will see that many problems, many traders described on some website are not really problems, but a misunderstanding on how brokers are working with your trades.
Okay, thank you. Just one final thing before we wrap up.
Perhaps, Chris, just another point. If you consider to open a small account, for example, because many retail traders start with a small account, which is normal, and it is also my advice, always start small. You can also consider to open a trade through an introducing broker. There are several introducing brokers, and don't believe it will cost you much. This is not the case, but the introducing broker will have an important influence with the broker, the final broker, in the case you have a problem, because the introducing broker may have developed a lot of business with the brokers he's working with, and this may be a great help for the retail trader. So this is also a point you have to consider when you have to open an account.
Yeah, most times the introducing broker doesn't cost you anything any more than if you'd gone to the broker himself. But because they're getting some money from you, you can ask them questions, and they've got more power with the broker to get things changed. And in the past, I had funny spikes pop up on my trading charts, and I would ask the introducing broker, and he would go back. He would compare the charts with other brokers and say, no, every other broker has got these spikes. But there was one time when the broker that I was with had a funny spike, and he did go back to the broker and say, what's the spike? None of the other brokers had it. It was a while ago. I can't remember what the resolution was, but he went to bat for me. So they can help that way. and they're also really helpful for sorting things out, like technical questions about things like margins and stuff like that. They may be able to help you with. Which brings me to the final point. Somebody has written, I would like to ask how to avoid going greedy. I've started 3 times in Forex, yet I end up losing it because of going out of limit when deciding the lot sizes. So in our trading methods, we recommend that you don't risk more than 0.5% to maybe 1%, absolute maximum 2% of your account when you're trading. And what that means is that if you've got a count of, say, $100, then 1% risk is $1. So you wouldn't place a trade that if it lost, went back and hit your stop loss, you would lose more than $1. So that's what we mean by risk. And we're really crazy about protecting your account size, because if you lose your account, you've got nothing to trade with, and trying to make profits is out the window. So we go for risk, protecting your risk before making a profit with us. And the other thing, is when Eusebio was bringing up the charts and showing R equals 13.3 or something like that, that's a multiplier of your risk. So if I had risked 1% of my account and the R value at the end of it was 13, then you can multiply 13 times 1%, gives you a 13% profit. So that's what that number's about. It kind of gets rid of all the pip sizes and how many dollars you had running on the pip. It gives you an overall value on how much you would have increased your account by. It also works on the dollar value. So if I risked $1 on a trade and I made a 13 return, then I can multiply my $1 by 13, and I know that I made $13. So it's just to give you a quick idea on how that R value works.
Yeah,
I know it's a bit late. Yep.
Yeah, in fact, a key point to become successful in trading is the risk aspect. If you take too much risk on each of your trade, this is a sure way to go to failure. Because never forget one thing. When you are in a drawdown, your drawdown may increase linearly, but the profit you need to recover your drawdown, so just to be break-even in your trading account, increases exponentially. For example, if you have a drawdown of 50%, you have lost half of your account. You need to make 100% profits on your remaining account just to be break-even with your account. And so this is why, in fact, if you focus on the result of your trade first, you will have a tendency to ignore the risk, and you will be tempted to use a larger risk and a larger risk and a larger risk, and you will get you will fail, in fact. If, on the contrary, you focus on the risk aspect, even with a small risk button, even with 0.5% risk per trade, then you will trade much more comfortably. You will develop that skills and courage to stay in the trade as long as the trend is valid. This is also a key point. Of course, you will make less profit using a smaller risk, but the compounding process, trade after trade after trade, will work in your favor, and the compounding process is a very, very powerful one. With the power of compounding, you can achieve any financial result you want, in fact. So small risk and a nice growth. I like to say start small and grow big. So the risk aspect is really the one key point in the activity of trading, in fact. And this is why it is important not to be greedy. I am personally greedy in my trade, but to milk a trend at best, not to make the biggest possible profit using a larger risk. I like to make big profit, but with small risk. And it's true that we can have nice profit using small risk. It's not an obligation to have big risk to make big profits. That's a myth, and that's wrong, completely wrong. Thank you very much for your participation today, for your questions. So I will leave the page with the summary of all the information here, and especially also the contact details. For 5 minutes, I will close the room in just 5 minutes. Bye everyone, and see you soon.
Thanks everybody.